those two. I feel like the biggest problem I have is finding the technology or hardware and resources to get these projects done, because with the stock exchange you have a way to finance a company and finance a growth of equity through an exponential growth model that employs a closed-end, open-ended fund. And with that fund, you get growth from the people who are buying the fund. You can issue creation units, give your market makers a chance to create their own units in case they don't have any. That's normally how it works, but especially with the Qs, they'll issue 10,000 shares at once, but I think the creation units, particularly in the Qs, are 50,000 shares. So you have to create at least 50,000, which you're probably not going to get, a single order that large. You generally won't. So you take that risk in the interim when you put it on your books to sell it. But, in the sense that all you're trying to do is make commission money, you could skim off 1/10 of a cent and, that would be all your margin of error. And I feel like the way to do high frequency trading is to always be at the bid or ask, always be the best bid or ask. And the easiest way to do that is to use a platform that enables at least 5th or 6th decimal trading. So if you use the 5th decimal, you just reduce it until your order gets filled. You should be able to use that in your trading, but it's such a simple algorithm, I doubt it would work. It seems like there's a lot of entries and bullshit that goes on. I moved it up to 100,000 orders per second on the exchange, and they're doing that. It's very obvious. I think we reached 4.5 billion shares traded on NASDAQ, NYSE, ARCA, and Amex, and that's a lot of trading. It doesn't seem like the investment community needs to be trading that much, but I know when I was doing an internship at Hilliard Lyons in 2005, there was a statistic that one of the brokers called pathetic, that average hold times had dropped to less than 12 months to 11 months. And obviously it doesn't agree with hyperactive trading, but I guess hyperactive implies over trading, or trading excessively. But high frequency trading, I would say, has a purpose, at least to fill a function of liquidity. And the processes I plan to use would have a trade at 10 a.m., 12 p.m., 2 p.m., and 4 p.m. So the 4 p.m. would give you a trade that would be based on a reverse silent double Dutch auction. The way the reverse silent double Dutch auction works is that you have somebody submit a bid, you put the money into escrow, because that could be their purchase price, and they're committed to buy all of it. So it functions as an all or none order, and it really is an all or none clearing market, but with a limited amount of trading times. You can also create a fund off to the side that can arbitrage it. So if it expects the next auction to be higher for whatever reason, you can expect that in that case you'll expect the fund to go higher. So with the closed-end fund, that fund is a high-frequency traded fund that will be publicly registered, just as I think the Kansas City Stock Exchange will be a public corporation soon. And KC Capital Management will probably file an S1 along with papers to start a relationship between KC Capital Management and the Kansas City Stock Exchange and the fund that invests in equities. And it might not be an index. It can be, over-allocated or overweight, as I'm sure some analysts would like to say. But if we do that, the money that comes in for the closed-end fund goes to buy shares in the open market for companies on the Kansas City Stock Exchange, and those trades create revenue, probably a percentage from 0.5% to up to 10% if the intent is to raise equity by an open market auction without seeing if there's any open interest. You can just try to have an auction and maybe someone will take it, but they don't have to. And until you have that first seller, you have to have at least 2 buyers to make it competitive, and maybe those buyers might want to collude to lower their price, in which case it does help to have a reserve price. But we'd expect that to be the case, because if you're expecting a certain amount and you don't get it, some auction houses will work that way on art or real estate, but if they had a choice, I'm sure they wouldn't take those offers. Can't wait to play ice hockey again. It's been the summer here and we don't have a summer league. Well, I just skated around the east side of Old Bridge. I'll just go to this west side, but the road to the right up here doesn't have a good enough street to go on. So all I'm saying is, if you can risk $750,000 and know that it's not going to go to zero, but it might go down $500,000, is that worth making $2.5 million? I don't know. I think it is. I can't think of a reason why not, but I should say the specifics on that. A closed P&L is $685, and the open P&L is $1.8 million, about a little bit more. But when you calculate risk reward, I don't know, the Sharpe ratios I don't believe are calculated properly in multi-charts. They seem to be always too low, but you might argue it means the model is no good, but that I don't think is what it means. I think it's just, a possibility that it's overestimating the standard deviation, which, if it is, probably explains why I'm expecting a 2 on a Sharpe ratio from performance like that. But until it actually takes the profit, it's not actually registering that, so the Sharpe's going to be very low, and in multi-charts it doesn't count it until it's a closed profit, which I guess is fair, but that's one of the reasons why there's why the Sharpe ratios are very rarely above 0.5 per contract. You can't measure a portfolio with annualized return, which I wish you could. I think that would be a great option. But you'd also have to add fees, like a quarterly fee to the platform, and percentages of profits charged either quarterly, which is the way I want to do that. At least I have it set up in my RIA and my CTA, is to offer a clawback, because some people don't want to give you a percentage of profits unless you earn a high water mark. I feel like that's no good for the advisor. Maybe good for the client, but I think if you offer a clawback, say you do semi-annual percentages of profit payments and make it an annual reset in that first 6 months. After 6 months, you calculate your profit, whatever it is. Say you take 10% or 33% or 50%. You pay that to the advisor. It creates a great incentive to outperform. And the point is that even if you just make 2%, if you have a person that's got a $10 million account with you and you only make $200,000, well, you're going to get $20,000. But if they give you some bullshit mark to hit, like 7%, I've heard, and 10%, I mean, you're not going to get anything despite those profits. It could be higher. I mean, I know that wouldn't be a good return after 6 months, but I guess depending on what the market did, it could be good. But the clawback comes in that second 6 month period, where if you have losses, let's say you made $200,000 in the first 6 months, and you get 10% of that, so the advisor gets $20,000. Well, the advisor has to exceed that $20,000 as well as any fees. So if in the next month you lose $200,000, or say you lose $100,000, just to show the subtraction, you will have to pay back $10,000. And if the advisor's smart, he'll put this money away and probably invest it alongside the client. And when he does that, he'll be able to create a very profitable institution. I feel like that's the best way for any advisor to do things. But I guess the rules are they have to be accredited investors. And I just had Interactive Brokers tell me I can't have any more than 15 clients, but I guess when I was at my max, I had about 12, and it went down. So, that's financial theory for you. It's all financial science, capital management, arbitrage, risk management. You put together some theories that you're studying the CFA curriculum for a few years, and you really learn something about finance. Even the quantitative methods I use are generally accepted by the financial services industry. I don't know what to say about the programs I'm doing in multi-charts. Trend following is at least a popular algorithm, but I don't think anybody's doing it correctly. If they were, they'd have results that were similar to this. It's up 16% this year. I think after being up 90 in the year before that, and like 75 or 78 in the year before that, and the 100% profit in 2009 was pretty nice. That's mostly where the high APR of 135% comes from. I guess it's hard if that's a 50% drawdown. The Calmar is only about 2.4, 2.35. But keep in mind, I'm I'm skating and trying to concentrate about these things all at the same time. So I guess I've explained a lot of what I'm trying to do. Don't know if this is the best setting for it, but I hope you enjoyed the ride. This is where I started. So yeah, KC Capital Management, the Kansas City Stock Exchange.